The FOMC minutes are out, and we have a breakdown of the statements that are going to kind of get brought up by market participants the most. And this is not really a bullish thing. Some people are trying to pick out the bullish parts, but overall, the Fed minutes are pretty bearish, guys. So we're going to get into everything you guys need to know on the Fed minutes on AMC stock here today, as well as give you guys an update on this collateral / margin call crisis that I do think is on the near-term horizon, and that comes down to big tech actually falling in value. So let's get into all of this information. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. Now, like I said, there's something for everyone here. Okay. The headline from CNBC says Fed officials less confident on the need for more rate hikes. Minutes show. So it's a weird way to put it. Sounds bullish or sounds bearish, right? Fed officials less confident on the need for more rate hikes. Kind of could read either way. That's a weird way to actually phrase that. But some of the main headlines are the Fed shows a split on more rate hikes. So instead of kind of everyone expecting more rate hikes, it's a lot more split. They urge for data dependency. They say that cuts are unlikely. They did throw this in here too, that the debt limit hike is essential to getting inflation down to their 2% target. I think that really means you got to raise the debt ceiling or the Fed's going to have to cut rates and we're going to have an economic disaster on our hands. Pretty interesting, though, the Fed is commenting on the debt limit. The Fed also says that inflation is unacceptably high, which, yeah, we get that. Inflation is unacceptably high. People can rejoice and celebrate 5.5% core inflation all they want, but when the target is 2%, you're far off of that. And the Fed's basically saying that they may need to do more. But as of right now, some Fed officials, are kind of expressing the need to maybe pause. Now, they also say that they forecast a mild recession later in this year and for growth to pick up in 2024. So you are getting some pretty bearish comments here from the Fed minutes. And this is something we have been waiting to hear from because this was the big catalyst really of the day today. And it's pretty much in line with the other Fed speakers in what we've heard, that potentially more rate hikes. The Fed really wants to not be boxed into a corner right now. The last thing the Fed wants is the markets to, predict this pause when maybe they shouldn't be pausing, right? So you're kind of seeing the Fed trying to push back on some of that. And let's go ahead, take a look at the Fed rate monitor tool. It did come down just a little bit in the last couple of hours. The odds of a pause now sit at 65.8%. Previous day probability was 68.6%. So down about 3% in the probability of getting a pause. Rate hike odds are starting to climb. And why I'm really focusing on this for you guys in a lot of these videos, kind of broad market stuff, just besides the fact that you should stay up to date with it, is because the margin calls and collateral crisis that could ensue really heavily revolves around those stocks falling, right? Your Apples, your Microsofts, your Googles, your Amazons falling in value. And, these bearish things that are happening, the Fed, the debt ceiling, potentially NVIDIA earnings, I kind of think that's going to be a bearish event. Maybe not. Who knows? But these things happening puts pressure on large tech because this rally in the markets has not been equal, right? Most stocks have not rallied or participated in this uptrend in 2023. It's just the largest of the large stocks that have, participated. You could see the whole time the markets have been rallying, the breadth, meaning the average stock, has actually been declining in the NASDAQ as well as the S&P 500. So you are getting a hawkish Fed, another domino that is falling, getting us closer to those margin calls. You can see the S&P 500 is down about 0.84% today, maybe heading to the lows by the last couple minutes here of trading. We'll see what happens. Things could get pretty aggressive, pretty violent to a downside move. You didn't really get a huge bullish narrative from the Fed minutes. Now, in terms of the debt ceiling, it looks like Kevin McCarthy, as far as what he said at this conference at 11:45 Eastern time, basically said they can come to an agreement on quite a few things besides spending. He says Democrats have hiked their discretionary spending by 33%. No household in America has been able to do that. Washington shouldn't either. He said there's a couple sticking points to them passing a debt limit raise at this point. Number one would be there's not going to be any more taxes. Thank you, Republicans. Appreciate you. Uncle Sam, he's already pretty deep in pockets out there. So that's a big problem. Democrats want to hike taxes. And the spending problems. So it's clear that the government brings in enough money. They're at the highest taxation rate that we have seen. They're bringing in the most amount of money that we have seen really ever. You got to go back to 1944 and what was going on then. You were in World War II to get to the same GDP percentage of revenue coming in. About 20% of GDP comes in revenue to the government a year. And they're having a hard time managing that. It's clear without spending cuts, you're not going to get a debt limit that will be raised. Obviously, that would be like economic Armageddon if the debt limit was not raised and the U.S. actually did default. But even just cutting spending is probably going to be negative for the stock market. And Kevin McCarthy pointed this out. A CNN poll says 60% of Americans say debt ceiling increase should come with spending cuts. Yeah, sounds about right. So that's what we are getting here today. Kind of bad news across the board. Bad news with the Fed potentially raising rates again and more, with really not too much of a inclination to hold rates. They're remaining data dependency, but it doesn't look like they're seeing data that would support a pause. And then this debt ceiling situation, and who knows what's going to come from this. You have 8 days left until we default, and a lot of experts and analysts believe it'll take 10 days for a bill to be agreed upon, to be passed through the House, to be passed through the Senate, and then be signed by Biden. So the clock is really ticking here, and it doesn't look like we're getting anywhere anytime fast. So these are things that I believe will continue to weigh on this market, as well as here in after hours. Nvidia and Snowflake, these are the big guys I want to watch for your kind of AI. If these guys are negative, it's going to push down the broad markets. Now, Nvidia doesn't typically have the biggest impact on the broad markets, and I think this is interesting because for the first time in quite a while, I think Nvidia will have a big impact on the broad markets. Because why? AI. And Nvidia basically started this whole AI trend or fad or whatever you want to call it. But before, it wasn't really correlated with big tech. Nvidia could report earnings and fall or pop, and it really wouldn't do too much to the markets. Now it's kind of like a Microsoft or Apple, whereas if Microsoft or Apple has bad earnings, well, the whole markets are going to feel the pain. That's what we are potentially facing with Nvidia earnings. Now, Nvidia has rallied so high, it's hard to be pretty bullish heading into Nvidia. Nvidia is up quite a bit. I mean, just look at this chart. That looks pretty bubblicious, okay? So I think Nvidia is going to be a very big piece to this puzzle. Once that is out the way, you're probably going to get markets moving a lot more, again, because of AI. And that could really catapult a move higher. That's possible. Or a move lower, guys. So that's what I have for you guys on a broad macro kind of basis. For tomorrow, let's go ahead and run through the economic calendar. So you're going to have GDP price index quarter over quarter, second estimate for Q1, expected to come in at 4%. Corporate profits for Q1 expected to come in at negative 1.3%. GDP growth rate quarter over quarter, second estimate for Q1, expected to come in at 1.1%. Chicago Fed National Activity Index expected to come in at 0.2. Initial jobless claims expected to come in at 245,000, up from about 3,000 from last week. So not expecting too much there. And we seen this not last week, but the week before that. You missed big time on initial jobless claims by like 25,000, and the markets did sell off about 1% that day. So I do think that will be a little bit more important. Now, real consumer spending quarter over quarter, second estimate is expected to come in at 3.7%. Previous number was 1%. So you're expecting a pretty big revision there. Core PC prices, expecting that at 4.9%. Last month's reading was, this is quarter over quarter, of 4.4%. So expecting an uptick there as well. Pending home sales, expecting that to come in year over year, negative 19%. Pending home sales month over month, expecting that at positive 1.2%. Fed Collins also speaks, and all of that data comes in between 8:30 in the morning tomorrow and 9:30 in the morning tomorrow. And then you're going to have Fed Collins at 10:30 in the morning, 8-week bond auction at 11:30, as well as a 4-week bond auction again at 11:30. Kansas Fed Composite Index, expected that at negative 14. Kansas Fed Manufacturing Index, expected that at negative 27. So you are loaded up as far as data that will be coming out tomorrow. And obviously, depending on expectations, if it's higher, if it's lower, for any of these data points, it can and will have an impact on the markets. You're basically going to get a data dump tomorrow. And if the markets take it good, well, it's going to be good. If the markets take it bad, probably going to be pretty negative, guys. So that's what I have, again, as far as the events for tomorrow. But really, I think NVIDIA is going to be more important than all of this, at least for tomorrow, at least in the short term. Now, if you guys have not watched the last video, definitely go ahead and check that out. It looks like the short interest in AMC is sitting over 37%, and that is calculating the deep in the money options that are likely already hedged for by the market makers that don't show up in the live short interest. When market makers have to go out and do their market maker duties and short stock because a bunch of people are buying puts, well, it doesn't get reflected as shorting pressure, much the same way as a gamma squeeze. If a lot of people go out and buy calls and push the stock higher, the market maker doesn't get listed on Fintel or other, data providers as a holder in AMC, or any other stock. They just don't get reported at all, but they're definitely there, right? When a gamma squeeze is happening, there's no denying the market makers are buying shares, right? Same thing to the downside, but the downside gets much, much more overlooked because, again, it's not right in your face. A lot of people care when stocks go up. Not a lot of people care as much when stocks go down. So that is what is negatively affecting AMC stock. And like we said in the last video, the silver lining to that is it's still short interest. They still will cover. And it can still push you up quite a bit. Reverse gamma squeezes can be pretty aggressive to the downside, but they can also unwind pretty quickly. If AMC does get a positive catalyst or any reason to go higher, the stock could rip, right? The stock could absolutely rip from here. So I think that is more positive than not, obviously. Now, the live short interest up free float at 25.22%. I'll also add that shorts, they don't want you to know that the short interest is like 37%, right? 25% looks a lot better than 37%. And that's ultimately what it comes down to, is that's why they're buying those deep in the money puts, so they can short the stock, but not have it actually come up as being, 37% short. You are looking at 130 million shares that are currently sold short. Cost of bar average at a 74.25. Cost of bar max at 92.79%. Cost of bar minimum at 31.26%. Interactive Brokers has about 850,000 shares that are currently available to be lent out with a cost of bar fee of about 50%. Now, if we look at the option activity for the day today, dude, no shocker here. I mean, look at these trades. You're seeing millions of dollars in single orders coming in to buy these $10 puts. It's so obvious. It's like right in your face. And while this is negative, it is downside pressure. It's going to reverse at some point. And when that reversal does come, market makers are going to go out and buy a lot of shares of AMC. Now, if we take a look at the interesting flow sentiment today, you have 6 orders totaling about $4 million. Positive order value of 0. 0 positive order value from institutions. But if we take a look at the whole entire option chain and this Friday's option expiration, the volume today for Friday's expiration is 77.69% calls, 22.31% puts. Overwhelmingly bullish here on the option, volume for the day today. Now, taking a look at AMC stock, AMC is firmly in this demand zone at the lower end range of $4.81 per share. Yeah, that has got pretty rough. You're really at the low end range of this demand zone. I expect you would get a bounce if you close, under $4.80 per share. Around the same level, we got a bounce right here on April 24th, which is about $4.65 per share. But again, I want to point this out. When you're seeing this kind of option activity that is so negative, it's all relative to volume. So if we were seeing this kind of option activity when AMC had 20, 30, 40, 50 million shares trading hands every day, like we've seen in the past, it doesn't make that much of an impact. But when you're seeing this kind of option volume on some of these deep in the money options, and AMC is, seeing volume of 12 million on the day, that makes a much larger impact for, call it 2 million shares market makers had to short today, roughly. I mean, that's a much bigger deal than if the volume is 30 million or 40 or 50 million. So that's what is currently going on with AMC. I can't sit here and forecast when the next bullish catalyst is going to be. I can just kind of tell you where things are at right now, give you a little bit of an outline here. And I do think, big tech falling is going to put a lot of pressure on shorts to pledge more collateral for their AMC short positions as the value of their collateral falls. And I think that does put a lot of pressure on shorts. Now, we ultimately do need a good catalyst. We do need good news. Maybe that is GME earnings in between June 2nd and June 8th. Maybe that is a positive update from the courts. Maybe it could be anything else. But I do think at this point, the risk to reward looks a lot better going long in AMC stock right about now, guys. So that is going to do it here in this video. Hit that like button and subscribe to the channel. Source your comments, questions, or concerns down below in the comment section. You guys have a great rest of your day, and I will see you in the next one.